let's really get into what bad debt truly is, because oftentimes I see folks on social media, even some of my former clients, they get so comfortable in this idea of what they think accounting and bookkeeping is, and they truly miss out on what it entails because they're not doing the work, right? So to give them some grace, they're not doing the work, they don't understand it. So let's talk a little bit about defining bad debt. Bad debt is a debt that becomes worthless because you can't collect on it. And it's only really an issue if you're a corporation that's doing accrual accounting, not cash basis accounting. Okay. So with accrual accounting, the debt is owed to your business, right? And it's considered a receivable account. You're expecting to receive payment on this account for a particular order, for a particular service or product. Accounts receivable. Okay. And that accounts receivable is listed on your balance sheet as a current asset. If you are cash basis in your business right now, you don't have a concern for accrual accounting. It is outside of your wheelhouse. It is outside of your scope of worries. So let's use a good example, a very simple example. If you charge a client, let's say $1,000 for coaching services that you performed already, and you've entered that transaction into your financial system, you should have a financial system, okay? And the transaction is essentially going into your books as accounts receivable. So it counts as $1,000 being added to your assets, along with cash coming into the bank accounts, deposits going into your savings accounts, deposits going into your business investment accounts, any like inventory or goods or products that you purchase to essentially or eventually sell. So anything that holds value in your company is an asset. Okay. So even if the balance of the invoice hasn't been paid yet, the value of that service, that output of the product, is still considered to hold some form of value, which is a part of your assets, your current assets. So let's say the client owes you $1,000, but the client goes out of business, they go bankrupt, they can't pay their bill. That $1,000 is now considered to be uncollectible. And the uncollectability of that invoice becomes bad debt. Remember, bad debt is worthless. You can't collect on it. Okay. So you now have to take the accounting steps to remove that $1,000 from your assets. And now you have to balance your books. Here's what folks don't understand about accounting. Okay. So accounting is not just one side of a transaction. There's always two sides at a minimum to a transaction. So let's say you have a subscription with QuickBooks, Wave Apps, FreshBooks, Zero. It doesn't really matter the software. The reason why you don't see those other sides of the transaction is because the software is doing that for you. Okay. So if you have $1,000 coming into your books, you just thinking your non-accountant exposure, you're just thinking like, I just have cash coming in the bank. That's it. That's not it. You have an increase of cash, right? If you're doing accrual accounting, you have a decrease in your accounts receivable, right? So you're touching two areas on your balance sheet. You have an impact also on the profit and loss statement, which is increasing your revenue, which has nothing to do with the balance sheet. Okay. So just because you can't see it on the surface in accounting, there's always multiple sides to a transaction. The software is just doing most of the work for you if it's set up correctly to you DIYers. So let's take a little bit of a step into the differences between cash accounting and accrual accounting, because I think that's important too. So let's talk about cash versus accrual accounting. It really doesn't matter if you decide to do your own bookkeeping or have someone else do it for you, you outsource it. Usually, there's going to be one of two methods of accounting: cash basis or accrual. So, the accrual method is anytime you charge, let's say, a client or customer some sort of fee, you're going to record that fee as income on your profit and loss statement. And even if you haven't received the cash yet, under accrual accounting, you're going to recognize that income on your books. Okay. Same thing goes for expenses. If, let's say, your graphic designer, for example, sends you a bill, an invoice, it's going to be recorded under your accounts payable. So I talked earlier about accounts receivable. Accounts receivable are funds you are expected to pay. Okay. I'm sorry, expected to receive. Accounts payable are funds you are expected to pay out. Expected. Okay. So you're going to recognize that bill, that invoice that you owe to your contractor, your consultant, your attorney, right? Your market research assistant, whomever. You're expected to pay this bill. So you're going to recognize it as an expense, but also as a liability, a bill that you owe. Okay. Once you get the cash into your account, right, from the client or the customer, and you pay the bill, you now complete a step, an accounting step. Well, the software is completing an accounting step. So once you get the cash in hand, you pay the bill. You're now converting your accounts payable or that accounts receivable to cash. It's no longer expected. It's already been paid out or received. Okay. Now, the entire process obviously is more complicated. If you're an accountant, you know about T accounts, right? That's how we learned in school. But essentially, this is why you need to give credit to accounting professionals, finance professionals that help you to set this up right. Because you can imagine if you're DIY and you don't have a basic foundational level of understanding of where these amounts are supposed to be hitting, whether it's an asset, a liability, an expense account, right, an equity account. If you're not sure of where these amounts should be hitting, you can easily make mistakes. Very easy. Because on the surface, if you're in a software, a QuickBooks software, Wave apps, you're thinking, oh, I just need to categorize this because that's what you see on the surface. You're not worried about what these dollar amounts, what accounts these dollar amounts are touching, and if they're correct. And that's why when the dollar amounts are hitting these financial statements and the financial statements look crazy, like they look completely off, that's why, because you don't have a foundational level of understanding of the accounting and how it's supposed to look. So someone asked me on social media, I did a screen share of a sample balance sheet I found on the internet and just walking them through assets, liabilities, how we get to current assets, current liabilities, how we get to equity, all of that. I went through a simple balance sheet. And someone in the comments asked me, I want to do this. Can I do this without a degree? And I immediately went to, in my head, sure you can, but you're going to need some foundational level of training and understanding. Foundation, basic, okay? Don't discount what we do. Okay, so let's get back into writing off unpaid services or unpaid products that were expecting a client or customer to pay for. So in the beginning stages, many solo entrepreneurs, small businesses typically are going to start off with the cash basis method of accounting because it's very simple. It's very easy to understand and implement. As you start to make more money and get, strategy from your tax pros, your tax strategists, you may have to do some conversions of not only your systems but your processes and how you process transactions. That's a part of the growth phase. So for those of you who tend to just bury your head into the sand and hope that it goes away, it's not going to go away. The more money you make, the more complex that your accounting and your financial management is going to become. Not maybe, it's going to become. That's just the reality. So the fact that cash basis businesses typically start off with this simple method, it could take some time to kind of understand the transition from cash basis to accrual method. So you don't necessarily want to get into the weeds of DIYing. You want to get a reliable software and a system that's going to be able to do all of these transactions for you in the background, because you can imagine how manual this is if you are a high volume business. For those of you who have coaching programs, academies, memberships, digital products, physical products, child, don't even get into events. You can imagine how many transactions that is to make sure that all of these dollar amounts are hitting the correct account, and you're trying to do it manually because you think you're saving money. You're not. I can promise you that. So when you have a bad debt on the books, your financial records, your record keeping manually is not going to catch that. Your software may catch it, but a person, a human, typically has to fix it. Okay? So that matchup and correction and finding is usually called an analysis. Accounting teams across the country in corporations that you and I have worked in have financial analysts on their finance teams to fix and correct these errors at a very granular level and a very high level. Because, baby, when I tell you these errors pile up in just 30 days of activity, they pile up. Okay. So when clients owe you money, right, it's being recorded in your AR, your accounts receivable. It's going to appear as an asset on your balance sheet. But if the money is not collected, it's worth nothing, right? No value. Okay. It's no longer an asset. So we got to get that off the books. We got to get that off of your financials. So if a bad debt continues to accumulate, let's say this interaction, this invoice, this scope of work occurred in January, if you're on a calendar year, your balance sheet is going to have an offset. It's going to need an offset when that activity occurred, or when you realize, we're not going to be able to collect on this. It's time to get rid of this. And that could be in December at the end of the year. So you want to be able to Figure out if you're DIYing, know what you're looking at, know what you need to capture, know what you need to fix. And the biggest benefit of doing this is that you don't have to worry about all of these errors piling up throughout the year. Because the reality is, you're not going to have 100% collect a high collect rate in the beginning stages of your business and the growth stages of your business. That's just natural matriculation of people, right? We get distracted. We find service providers who maybe are a better fit. We don't pay attention. Like we be all over the place as humans. So it's just a natural part of your business is going to fall off. Just bake it in the numbers. Even if it's 5%, 10%, 20%, a natural part of your business is going to fall off. Unless you're an attorney, I don't see attorneys having that issue. But even if you have like collection agencies to collect, that's still debt that's sitting on the books that's not getting collected until you're able to. Okay. So if a client isn't paying, for services or products, any bad debt that you incur in the course of running your business is not likely to be deductible. Okay. So the bad debt deduction is going to apply to debt you've acquired as part of a natural business dealing, right? If you've purchased debt from another business, you found out that the debt was uncollectible, you could write that off, right? Since bad debt you incur as a consultant or coach or a service provider is not an expense. It's really income that was just never earned. So it can't be deducted. So be mindful of this when you're watching social media posts or videos and you see folks who want to build up their engagement. Sometimes they don't always tell the truth. So always fact check. So unpaid bills do reduce your overall tax liability because ultimately they're reducing the income or revenue that's taxable. Okay, so don't seek for deductibility unless you're in the business of buying debt to eventually collect on it. It's a no. To keep it very, very, very simple. So in the next episode, I'm going to talk a little bit about ways to minimize bad debt, ways to make it very easy for your customer to pay you, and ways for you to increase your cash collection and your cash management so that you're not putting out services, putting out products before you get paid. And you definitely want to retain an attorney to build up the agreements that you need in your course of business. I hope you guys have enjoyed this episode. Let me know your thoughts below. Have you learned or heard of something different about how bad debt is handled in a business? Let me know below. See you in the next episode.